Hello, and welcome back to our podcast series on the top shelf, which deals with topical issues when engaging with the IFRS accounting standards that impact clients operating in the retail and consumer industry. My name is Shreya, and I am a senior manager in PwC's corporate reporting services. Today on the podcast, I've got Rensha van Noordwijk. Rensha is a partner in the corporate reporting services team. She is a specialist in financial instruments, which includes IFRS 16, the leasing standard. And that specialist knowledge will really come in handy today when we unpack the concepts of sale and leaseback accounting. Welcome to the podcast, Rensha.
Thank you, Shreya.
Rensha, there's been an increasing trend of unlocking value within the retail space by divesting oneself of non-core property. For example, distribution centers or other large fixed properties that don't necessarily need to be owned by a retailer. These non-core assets can create value by being sold to a third party, sometimes a REIT, a real estate investment trust, or other property investors. The assets are then leased back by the retailer.
That is correct. A sale and leaseback transaction is normally a way for the seller lessee to raise capital. They sell an underlying asset, a fixed property like you've just mentioned, and then they lease the asset back from the entity that purchased the asset. The seller effectively gets proceeds from the sale of the asset without losing the right to use that asset when they lease it back. In this manner, a seller obtains the value of the asset in cash up front, and generally also transfers the related obligations to manage and maintain the properties to the buyer, which can make it attractive from both a commercial and operational perspective.
I can completely understand why this might be a good value proposition from a commercial perspective. The accounting, on the other hand, though, that can sometimes get quite tricky, right? Could you talk us through some of the basic points to think about?
Yes, it does become quite tricky. But to start us off, it's important to first identify what has been sold. For example, some companies might move the asset or a group of assets being sold into a corporate wrapper, like a new company, and sell the shares in that company to another entity while at the same time entering into lease agreements for the right of use of the asset or some of those assets. The question is then whether the loss of control principles of the consolidation standard, being IFRS 10, or the sale and leaseback guidance of the leasing standard, or potentially both, should apply, as the end result between these standards are quite different. Remember, under loss of control principles, the full gain or loss would be recognized upon loss of control, whereas under the sale and leaseback principles, a portion of the gain or loss should be deferred, which we will explain a bit later.
I'm following. So in other words, we really need to identify what are you selling? Are you selling an asset or are you selling an investment in a subsidiary? Maybe to take it a step further or just explain a bit differently, it would also be important to check when setting up a sale and leaseback with a shelf company or a newco, to what extent that seller lessee actually controls the so-called buyer from an IFRS 10 perspective. I mean, you don't want to create a situation where the right hand is selling an asset to the left hand, right? Now, if a transaction involves both the loss of control of a subsidiary and a sale and leaseback, it is not quite clear in the standards whether a full gain or loss should be recognized in accordance with IFRS 10 or only the gain or loss that relates to the rights transferred in accordance with IFRS 16, the leasing standard. Now, taking it a step further, a similar matter was considered by the IFRS Interpretations Committee in September 2021, when they issued a tentative agenda decision. However, subsequently, in February 2021, the IFRS Interpretations Committee subsequently decided to escalate or refer this matter to the International Accounting Standards Board, that's the IASB, and they recommended that the IASB undertake a narrow scope standard setting to address this and similar transactions, and that matter is still currently ongoing. But we're not going to be deep diving into this matter on today's podcast. This is more of a heads up or giving you some food for thought around areas that could be complicated when dealing with a sale and leaseback. The bottom line at the end of the day is to determine the nature of the asset that is being disposed of in the transaction. Do I have the disposal of a business or an asset?
That is correct, Shreya, but let's come back to the basics. Once you've established that you are selling an asset, typically the next question to think about is whether or not the transfer of the asset to the buyer lessor in the sale and leaseback transaction would qualify as a sale under the accounting guidance. In order to determine that, entities needs to look to the guidance in the revenue standard, IFRS 15. In other words, the seller lessee applies the requirements for determining when a performance obligation is satisfied. That means, does the buyer obtain control of the asset to determine whether the transfer of the asset should be accounted for as a sale of the asset? A sale and leaseback transaction qualifies as a sale for accounting purposes if the buyer lessor obtains control of the underlying asset.
Thanks, Rensha. Are there any common pitfalls to watch out for when it comes to this step?
Unfortunately, yes. An example of such a pitfall would be where the seller lessee have entered into a repurchase right into the contract. So, for example, there is an option for the seller to buy back the asset being sold. The revenue standard specifies that an obligation or right to repurchase the asset would preclude the buyer from obtaining substantially all of the remaining benefits of the asset. And it's also limited in its ability to direct the use of the asset. Therefore, an option for the seller to repurchase an asset means that it would not qualify as a sale in accordance with the revenue standard, as the buyer is not seen as having obtained control of the asset, even though legal title and physical possession of the asset has transferred.
Okay, I think I'm following you. Can you help take it a bit further for our listeners and explain what are the consequences if the transfer of the asset is not a sale?
In that case, the arrangement would be considered in substance, a financing arrangement. In other words, if the transfer does not qualify as a sale, the seller lessee does not de-recognize the transferred asset, and it accounts for the cash that it received as a financial liability.
All right. So thus far, we understand that we need to watch out for what exactly are we selling. And once we clear that hurdle, the next step in evaluating a sale and leaseback transaction is to assess whether the transfer of that asset is a sale. And to do that, we turn to the revenue standards indicators of control. And if we find that the transfer of the asset is not a sale, then we ultimately account for the arrangement as a financing transaction, right?
That's correct, Shreya.
So let's take it a step further, Rensha. What about if the revenue standards indicators are met? In other words, if we pass that hurdle and if we qualify for sale and leaseback accounting in terms of the leasing standard, what next?
In that case, where we qualify for a sale, then the seller lessee de-recognizes the asset sold and recognizes a right of use asset for the lease rights it retains. It measures the right of use asset arising from this leaseback transaction as the proportion of the previous carrying amount of the asset that relates to the right of use that it retained. Therefore, any gain or loss that the seller lessee recognizes is limited to the proportion of the total gain or loss that relates to the rights transferred to the buyer lessor.
Okay, Rensha, I'm with you thus far, but I do have another question. What happens if there is a difference in the sale consideration earned by the seller lessee and the actual fair value of the asset sold? For example, a building is sold for 2 million when we know that the fair value of that building is actually, say, 1.5 million. What then?
That is a good question. Any difference between the sale consideration and the fair value of the asset needs to be considered. It's either a prepayment of lease payments, and that's in the scenario where the purchase price is below the market terms, or it's an additional financing in the scenario where the purchase price is above market terms. In your example, when the building is sold for 2 million Rand, when the fair value is around 1.5 million Rand, the 500,000 Rand above the fair value should be accounted for as additional financing. As a practical tip, we would encourage preparers to really understand the different values involved in these transactions to ensure that there's appropriate oversight from the experienced members of the finance team. Do not just assume that the sales price is the fair value for the asset being sold.
That's a great tip, Rensha. I agree. And especially when we're dealing with immovable property, these transactions tend to be for high values and can be quite material. I think we can agree that where there are high value transactions, these shouldn't pop up as a surprise at year end. Early engagement with assurance providers, such as the auditor, might prove very useful to ease pressure at year end. But speaking of year ends, Rensha, I understand that there has been some proposed amendments to the leasing standard regarding sale and leaseback transactions for annual periods beginning on or after the 1st of January 2024.
That is again correct, Shreya. There has been some developments in this area. This actually started a while back in March 2020 when the IFRS Interpretation Committee discussed a submission about a sale and leaseback transaction with variable payments that do not depend on an index or a rate. This could, for example, be a function of revenue or turnover. That means that the lessor pays rental based on a portion of the turnover generated by the asset. The question that was submitted was how the seller lessee measure the right of use asset arising from the leaseback, and that thus determining any gain or loss recognized on the date of the transaction.
I can see how that could be quite an interesting question. So, for example, if all of the lease payments in the leaseback were dependent on future sales of the seller lessee, that is, they're fully variable, like you just mentioned, the question arises if it would be acceptable for the lessee to measure that right of use asset and lease liability at zero, which would lead to a full gain or loss on the sale at the date of the transaction. That's definitely going to lead to some bottom line effect, right?
Yes, exactly. And to address this question, an agenda decision was issued by the Interpretation Committee in June 2020. The decision notes that because the right of use that the seller lessee retains should be measured as a proportion of the previous carrying amount of the property, plant and equipment, or PPE, sold, the amount of the gain or loss recognized must relate only to the rights transferred to the buyer lessor. So in other words, it would not be acceptable for the seller lessee to recognize a full gain or loss at the date of the sale and leaseback transaction, even in the scenario where you've just described, where the full payment is variable. Therefore, any gain or loss recognized should be to the extent that it relates to the rights transferred to the buyer lessor. The question then is, what about the lease liability? So the initial measurement of the lease liability that arises is now a consequence of how the seller lessee measures the right of use asset and any gain or loss recognized at the transaction date. Therefore, the initial measurement of the lease liability is determined as a balancing figure once you've determined the right of use asset and the gain or loss that can be recognized. This means that the seller lessee should always recognize a lease liability at the date of the transaction, even if all the payments for the lease is variable, whether or not they depend on an index or a rate. Interestingly enough, the Interpretation Committee concluded that the current leasing standard provides an adequate basis for an entity to determine the accounting for the sale and leaseback transaction at the date of the transaction, and therefore no amendments were made to the standard in this regard.
I see. Okay. So the crux of the matter is, if you're entering into a sale and leaseback transaction where the lease payments are variable that do not depend on an index or a rate, this can give rise to an area of complexity, particularly in determining the proportion of the asset retained versus transferred to the buyer. This sounds like a very evolving area, a very hot topic. Were there any other subsequent developments on this topic?
Yes, and that's where the amendment comes in. So in contrast to the initial accounting that we've just discussed, for the subsequent accounting of the lease liability and right of use asset, the original leasing standard didn't include specific measurement guidance. Consequently, it wasn't clear how to subsequently measure the liability that arises from the leaseback transaction, particularly where the payments for the lease include variable lease payments that do not depend on an index or a rate that normally would not be considered lease payments included in the lease liability. So remember, Generally, variable lease payments that are not based on an index or a rate are not part of the lease liability. They are rather recognized in the income statement when the event or the condition that trigger those payments occur. To address this question, around September 2022, the IASB issued an amendment to the leasing standard, which added some guidance on how an entity accounts for the sale and leaseback transaction after the date of the transaction.
Aha, I can definitely see why they'd want to clarify the accounting in that instance.
Exactly. The amendments to the leasing standard now provide some clarity on the subsequent measurement of these liabilities. However, due to our time limitations on this discussion, I will not attempt to try and explain the detailed requirements, as that is best explained working through numerical examples. The key takeaway for today is just to be aware that there are amendments to the leasing standard that provides us now with additional guidance in this area. And for further reading, the amendment does include numerical examples that our listeners can refer to.
Thanks, Rensha, for breaking down the issue for us. For our listeners, if you would like to read more about this, we do have illustrative guidance published, which will be linked in this podcast transcript on the PwC website. We've covered a lot thus far in our jam-packed podcast. We touched on some of the points to think about when assessing a sale and leaseback transaction, such as firstly assessing whether or not a transfer property qualifies as a sale under the revenue standard. We also briefly discussed an amendment to the leases standard dealing with cases where there are variable lease payments that do not depend on an index or a rate. Is there anything else you'd like to add?
Yes, so maybe in closing, I can share a practical tip for preparers. Always perform an overall sense check once the journals have been posted. If you think about the balance sheet, what have you essentially done if you have sold and leased back the asset? You've sold an asset, but as we've said, often real estate. You're letting go of the PPE and you're retaining a portion of that asset in the form of the right of use asset, which comes back on balance sheet as a leased asset. Now, depending on the renewal options that you've taken into account when calculating your lease term, you can do a quick sense check of the relative values. For example, if you've previously owned a building and your lease term is for a short period because you've not taken into account any renewal options, you'll see a smaller right of use asset come back onto the balance sheet compared to the value of the original PPE.
That is such a great point, Rensha, and you're keeping it so practical. It talks to the broader issues of not letting the pre-existing IFRS 16 lease accounting principles go out of the window. Don't become so focused on the sale and leaseback that you lose sight of other existing principles in the leasing standard. Remember, the lease term is the non-cancelable period of a lease, together with any optional periods that the lessee is reasonably certain to use. So, for example, if it's a key site that you have sold and leased back, for example, a distribution center that is very integral to a retailer, then one would anticipate renewal options to be taken into account when determining the lease term.
That is again correct, Shreya. Periods covered by an option to extend the lease term should be included in the lease term if the lessee is reasonably certain to exercise that option. The same rationale applies to termination options. Periods covered by a termination option should be included in the lease term if the lessee is reasonably certain not to exercise the termination option.
Speaking of the duration of the lease, our time is now up on the podcast. Thanks, Rensha, for joining me today and for sharing your insights on sale and leaseback accounting.
Thanks for inviting me, Shreya.
This podcast is brought to you by PwC. All rights reserved. PwC refers to the South African member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.